Disclaimer.
Hi, today the format is a little different. I'm not going to talk about silver, but about a topic that many of you have asked me to discuss. You order a jacket online because it looks perfect in the photos. It arrives, the color is completely off, the fit is wrong, and now you're stuck dealing with return labels, repackaging, and waiting weeks for your money back. You're not alone. Americans return nearly 1 billion packages every single year, and here's the number that should grab your attention. That massive hassle costs our economy $850 billion annually. That's not a typo. $850 billion lost to a broken system where what you see online rarely matches what shows up at your door. For context, that's more than the entire GDP of Switzerland disappearing into the void of return shipping labels and restocking fees. Now imagine someone tells you they've solved this problem, not with better cameras or improved descriptions, but with something that sounds like science fiction: digital twins, virtual replicas of physical products so accurate that you'll know exactly what you're getting before you click buy. No more surprises, no more returns, no more $850 billion black hole. They're calling it phygital commerce, physical plus digital, and investment pitches are flooding online communities right now. This is where our story begins in 2026, and this is why you need to understand what's happening at the intersection of technology, commerce, and your retirement savings. Last month, my neighbor called me. He's a retired aerospace engineer in his late 60s, smart guy who managed his own portfolio successfully through multiple market cycles. He was excited about a new investment opportunity someone in his online community had shared, a digital commerce project about to launch on multiple cryptocurrency exchanges simultaneously, promising to revolutionize online shopping with this digital twin technology. The early investor pricing seemed too good to pass up. He wanted my opinion on whether he should move $20,000 from his money market account into this opportunity. $20,000, a meaningful chunk of his emergency fund. Money he might need if his wife's health issues worsened or if their roof needed unexpected repairs. Here's what makes this moment particularly dangerous for American investors like my neighbor, especially those of us planning retirement or already living on fixed incomes. We're facing a perfect storm of economic pressure that makes these pitches land harder than they should. J.P. Morgan's latest economic analysis puts the probability of a recession in 2026 at 35%. That's more than 1 in 3 odds we're heading into another downturn. Meanwhile, inflation continues grinding away at our purchasing power at roughly 3% annually. Your retirement savings, your investment portfolio, the nest egg you've spent decades building, it's all losing value in real terms even when the numbers look stable. The groceries that cost you $100 last year now cost you $103. Your insurance premiums creep higher, your property taxes increase, and if you're living on a fixed income or Social Security, you're watching your standard of living slowly erode month after month. This creates psychological pressure that's hard to overstate. When traditional investments feel uncertain and your savings are losing purchasing power, the human brain starts searching for alternatives. We start looking for that next big opportunity, that technological breakthrough that could restore what inflation has stolen from us. We become, whether we realize it or not, vulnerable to promises of revolutionary returns. The pitch usually sounds something like this. Major e-commerce platforms are bleeding money on returns. Retailers are desperate for solutions. Consumers are frustrated with the current system. Whoever cracks this code will capture a massive market, and you, the early investor, can get in before the institutions and venture capital firms drive the price into the stratosphere. It's a narrative designed to bypass your skepticism. After all, you've seen Amazon transform from an online bookstore to a trillion-dollar behemoth. You've watched people who bought Apple stock early retire comfortably. You've heard the stories about Bitcoin millionaires who got in when the price was negligible. The question that keeps nagging at you is simple. What if this is real? What if this is your chance? This conversation happens countless times every day across America. Good people, intelligent people, people who've made sound financial decisions their entire lives, suddenly confronted with investment opportunities that promise to solve real problems while offering extraordinary returns. The pitch lands harder because it addresses genuine frustrations we all experience. Those returned packages, those mismatched products, those hours wasted dealing with customer service, these are real problems that deserve real solutions. Here's what you need to understand. The technology behind these promises isn't entirely fictional. Artificial intelligence has made remarkable progress in image recognition and three-dimensional modeling. Blockchain technology does offer advantages in tracking and verification. Major companies are investing billions in augmented reality and virtual try-on technologies. The foundation of the pitch isn't built on complete fantasy, which makes it more dangerous. But here's where we need to pump the brakes. Just because a technology is possible doesn't mean a particular investment opportunity is legitimate. Just because a problem exists doesn't mean the solution being offered will capture market value. And just because you're seeing promotional content across multiple platforms does not mean you're looking at the next breakthrough investment. According to the Federal Trade Commission, Americans lost more than $10 billion to fraud in 2023, with investment scams representing the largest category of losses. That number has continued climbing through 2024 and into 2025. The sophistication of these schemes has evolved dramatically, especially as artificial intelligence tools make it easier to create professional-looking websites, convincing white papers and persuasive marketing materials that look indistinguishable from legitimate offerings. What makes the 2026 environment particularly treacherous is how several factors converge to work against our natural skepticism. We're living through genuine technological disruption, where seemingly impossible things become reality at an accelerating pace, making it harder to distinguish legitimate innovation from elaborate fiction. Traditional investment returns have been underwhelming for many Americans, creating hunger for alternatives. And social media allows promotional campaigns to spread rapidly while creating artificial social proof through coordinated activity. The SEC has recognized this growing threat. Under Paul Atkins' leadership, the agency launched Project Crypto 2026, a comprehensive framework designed to bring clearer regulation to digital asset offerings. The goal is protecting investors while allowing legitimate innovation to flourish. But regulations move slowly and scammers move fast. The protection framework is being built while Americans are being pitched opportunities daily. You need to understand the playbook these opportunities follow. First, highlight a genuine problem that people recognize and resent, the return crisis. Second, introduce a technological solution that sounds plausible and revolutionary. Third, emphasize urgency through limited availability or time-sensitive pricing. Fourth, leverage social proof by flooding online communities with positive testimonials and excited discussions. Fifth, position the opportunity as a chance to get in before the mainstream catches on. This isn't necessarily coordinated by project creators themselves. Often, early participants become enthusiastic promoters because they have vested interest in driving up demand and price. They genuinely believe in the opportunity, which makes their advocacy more convincing than paid advertising. You're not being pitched by a sleazy salesman. You're hearing about it from someone who seems like you, someone in your investment forum or social media group, someone who appears to be sharing valuable intelligence rather than running a pump scheme. The question you should be asking yourself isn't whether the underlying technology could theoretically work. The question is whether this particular investment opportunity, offered to you at this moment through these channels, represents a sound allocation of your hard-earned capital. To answer that question, you need to understand how to evaluate what you're being shown. You need to know the red flags, the mathematical realities, and the specific tactics that separate legitimate opportunities from elaborate traps. That's exactly what we're going to explore together. Not by telling you to avoid all cryptocurrency or dismiss all innovative technology, but by giving you the framework to make informed decisions based on evidence rather than excitement, on mathematics rather than marketing, on protection rather than promises. Because in the uncertain economic landscape of 2026, with recession odds climbing and purchasing power declining, the most valuable investment you can make is in your own financial literacy. Understanding how to separate signal from noise, opportunity from trap, innovation from illusion, that knowledge will serve you far better than any hot tip or early access opportunity ever could. Let's talk about what happened when my neighbor showed me the investment materials he'd received. The promotional content looked incredibly professional. Slick graphics, technical white papers filled with blockchain terminology, testimonials from supposed early investors already seeing returns. But three specific claims immediately caught my attention. First, the project was promoting something called fiduciary AIs, artificial intelligence systems that supposedly act on your behalf, making purchasing decisions without the invasive advertising algorithms we've all grown to resent. Second, they emphasized security protocols with impressive acronyms like KCEP, designed to give seniors peace of mind about digital transactions. And third, this project was preparing to launch simultaneously on what they called the Big Four cryptocurrency exchanges: Binance, Coinbase, Kraken, and KuCoin. Now, if you're not deeply familiar with the cryptocurrency world, those first two might sound innovative and the third might sound impressive, but meaningless. Let me explain why these claims reveal everything about how sophisticated these schemes have become in 2026, and why they're specifically designed to bypass the skepticism of experienced investors like my neighbor. The fiduciary AI pitch is brilliant psychological marketing. It addresses a real frustration. We're all tired of being tracked and manipulated by algorithms that know more about our spending habits than we do. The promise of an AI that works for you instead of against you taps into a genuine desire for control and privacy. The security protocols with official-sounding names create an impression of institutional-grade protection. But here's what you need to understand. These features sound protective, but they're actually being used to create false security. According to Chainalysis, a blockchain analysis firm tracking cryptocurrency fraud, we've seen a 140% surge in impersonation scams targeting American investors in early 2026. These groups are leveraging the very language of security and compliance to wrap speculative assets in the appearance of institutional legitimacy. They use our own desire for safety against us. Getting listed on a major cryptocurrency exchange isn't like putting your product on Amazon. It's more like getting your company listed on the New York Stock Exchange, except the regulatory requirements have become even more stringent in 2026. Coinbase and Kraken, operating as publicly traded and heavily regulated companies in the United States, now face strict compliance standards under the new stablecoin laws requiring 100% reserve backing and months of rigorous legal vetting. According to their published criteria, they evaluate projects based on security audits, compliance with securities laws, demonstrated market demand, and extensive documentation about technology, team backgrounds, and token economics. The application process typically takes months, sometimes over a year. Their legal teams review everything to minimize regulatory risk, because their reputations depend on not listing securities that will later trigger SEC enforcement actions. This isn't a rubber stamp process, and it certainly is not something that happens quickly or simultaneously across multiple major exchanges without verifiable documentation or public filings. Think about what simultaneous listing on 4 major exchanges would actually require. You'd need 4 separate legal teams at 4 different companies, all completing their due diligence at exactly the same time, all while these platforms compete with each other for exclusive listings and first-mover advantage. The probability of this happening for a project with no prior market history approaches 0. But here's where the pitch gets clever. The promotional materials didn't claim these listings were confirmed. They used language like preparing to launch on or targeting listings on the Big Four. This linguistic sleight of hand creates the impression of legitimacy without making a verifiably false claim. If the listings never materialize, they can always say negotiations fell through or timelines changed. This is what we call shilling, using the names of our most trusted institutions to lend credibility to something that hasn't proven it can stand on its own. When we see this kind of aggressive promotion in online communities, especially in a year where the Federal Trade Commission reports the average scam payment has jumped to over $2,700 per victim, we have to ask ourselves, are we looking at a revolution in commerce, or are we witnessing the professionalization of a very old-fashioned trap? This is what I call the legitimacy mirage. The project surrounds itself with the names of real, respected institutions without actually having formal relationships with them. You see references to compliance with SEC regulations without explaining what that compliance actually entails. You hear about partnerships with e-commerce platforms without details about scope or implementation. Everything sounds official and connected, but when you dig into the specifics, the connections dissolve into vague language and future aspirations. Now let's examine the pre-sale price that accompanied my neighbor's opportunity, because this is where we need to get past the flashy marketing and dig into the actual mathematics. The promotional materials advertised a pre-sale price of 1.2 cents per token, or $0.012 if you're looking at it written out. On the surface, this looks like a ground floor opportunity, the kind of entry point we all wish we'd had with Amazon or Apple decades ago. But when we run the numbers against the actual valuations of e-commerce giants, a different picture emerges. The current market capitalization of Shopify, one of the largest e-commerce platforms in the world, stands around $100 billion. Shopify serves millions of merchants, processes billions in transactions, and spent nearly 2 decades building its infrastructure and market position. If a phygital commerce project genuinely solved the $850 billion return crisis and captured even 10% of that market value, it would deserve a market cap in the tens of billions. Here's the trap hidden in that $0.012 price. To reach the heights being promised in online investment forums and comment sections, this project's total market value would have to eclipse some of the most established companies in our country, all before a single digital twin has actually solved a real-world return problem for a major retailer. The price per token is meaningless without knowing the total supply. If there are 1 billion tokens at $0.012 each, that's a $12 million starting market cap. If there are 100 billion tokens, that's a $1.2 billion starting cap. The project can set the price point anywhere by adjusting total supply, making that low per token price psychologically appealing while potentially starting with an absurdly high valuation. But here's the trap. To go from a $10 million market cap to even $1 billion requires a 100 times increase. That means the price would need to go from 1 cent to $1. For every dollar you invest at the presale price, you'd need $100 of new capital to flow into the project to achieve that return. Where's that capital supposed to come from? According to Chainalysis, a blockchain analysis firm that tracks cryptocurrency flows, the total amount of new capital entering cryptocurrency markets has been declining in 2025 and early 2026 compared to previous bull market peaks. Institutional investors have become more cautious following several high-profile collapses. Retail investors have been burned repeatedly. The pool of new money available to flow into speculative tokens is smaller than promoters would have you believe. This creates a fundamental mathematical problem. For early investors to realize extraordinary returns, you need massive new demand from later investors. But if everyone is getting in early at presale prices, who are the later investors? This is the classic greater fool problem. You're counting on finding someone willing to pay more than you did, and they're counting on finding someone willing to pay even more. The promotional materials usually include projections showing the token price reaching $5, $10, even $50 within months of launch. These projections are never accompanied by realistic analysis of where the buying pressure would come from to sustain those prices. They're fantasy scenarios designed to make your $5,000 investment seem like it could turn into $50,000 or $500,000. Let's look at what actually happens in the typical life cycle of these launches. The presale phase attracts early investors with promises of exclusive pricing. The project raises capital, sometimes hundreds of thousands or even millions of dollars, from people like my neighbor. Then comes launch day, which is where the second major red flag appears, the volume to market cap ratio. This ratio is the single most important metric for distinguishing between a legitimate project with genuine users and a pump and dump scheme. Legitimate cryptocurrencies and tokens typically show trading volumes that are a reasonable fraction of their market cap, somewhere between 5 and 20% daily during active periods. This indicates real users buying and selling for actual utility or investment purposes. But in pump and dump schemes, you'll see explosive trading volume on launch day that equals or exceeds the entire market cap of the project. This happens because the scheme operators and early promoters are frantically trading back and forth to create the appearance of demand and drive the price up. They want to trigger FOMO, fear of missing out, in observers who see the price climbing rapidly. The goal is to attract new buyers who will purchase at inflated prices, allowing the original promoters to sell their tokens for massive profits. The volume typically collapses within days or weeks after launch as the promoters exit their positions, and new buyers realize they are holding tokens with no actual utility or underlying value. The price falls back below the presale level, leaving later investors with significant losses. Meanwhile, the original promoters have moved on to the next project, having extracted real dollars from the system. The SEC's Project Crypto 2026 initiative is specifically targeting these patterns. Under Chairman Paul Atkins' leadership, the agency is building what they call a better regulatory sandbox, a framework that establishes clearer definitions for what constitutes a security offering versus a utility token, while allowing legitimate innovation to flourish. The initiative requires more transparency about token distribution, disclosure of who holds what percentage, clear unlock schedules showing when insiders can sell, and mandatory background checks on team members, including any history of involvement in previous failed projects. It's true that our regulators are finally moving toward clearer taxonomy for digital assets, trying to separate legitimate utility from speculation. But here's what should grab our attention. While the SEC is building this sandbox for innovation, the scammers aren't waiting for permission. They're exploiting the transition period, wrapping speculative assets in the language of institutional compliance before the enforcement mechanisms fully catch up. But here's the challenge. Enforcement is reactive, not proactive. The SEC can't review every token before launch. They monitor markets and pursue enforcement actions after violations occur. By the time the SEC brings an enforcement action, it's often too late to recover your capital. This means you are the first line of defense. Understanding red flags before you invest is critical, not after. Let me walk you through the checklist I used when evaluating my neighbor's materials. First, vague team information. Legitimate projects are led by people willing to attach real names and reputations to the venture. You should verify team members' backgrounds through LinkedIn, previous companies, or published work. Profile photos without names, first names only, or pseudonyms are warning signs. Second, unrealistic timelines. Building functional technology takes time. If a project claims revolutionary AI and blockchain integration within weeks, question how that's possible. Real software development requires extensive testing and iteration. Rushed timelines usually indicate vaporware. Third, social media saturation. Pay attention to promotion patterns. Coordinated posting across multiple forums using similar talking points suggests organized campaigns rather than organic interest. Check account ages. New accounts posting only about one project are typically promotional. Fourth, pressure tactics. Legitimate investments don't require immediate action. Countdown timers, limited availability warnings, or presale almost sold out messages are psychological manipulation. Take your time. Do your research. Fifth, lack of working product. Does the project have a functional product you can use or see operating, or are you investing based on future promises? According to the Cambridge Center for Alternative Finance, over 70% of blockchain projects that raised money through token sales never delivered functional products. My neighbor's opportunity failed nearly every test. Vague team information, aggressive timelines claiming revolutionary technology in 8 weeks, obvious coordinated social media promotion, countdown timer, creating urgency, and no working product to evaluate. But the most revealing moment came when I asked him, what problem does this token actually solve for users? Not what does the technology claim to solve in theory, but what specific user need does the token fulfill that couldn't be addressed without blockchain? He couldn't answer clearly. The promotional materials had focused so heavily on investment opportunity and technical sophistication that they glossed over the fundamental question of utility. This is the ultimate test. Bitcoin enables decentralized digital money. Ethereum enables programmable contracts. Stablecoins provide price stability. Each has genuine utility driving demand beyond pure speculation. For any digital commerce project, the token should serve a clear purpose in the ecosystem, incentivizing accurate product information, rewarding detailed reviews, facilitating instant refunds. The token needs to be necessary for the system to function, not just a fundraising mechanism. When you can't identify clear utility, when the token exists primarily to raise capital rather than enable a functioning system, you're looking at a security offering dressed as a utility token. That's when legal frameworks become critical, because securities offerings come with disclosure requirements and investor protections these projects try to avoid. The 2026 landscape is filled with projects exploiting regulatory uncertainty. They use sophisticated terminology to sound legitimate while structuring themselves to avoid securities law violations. They target investors who understand enough about cryptocurrency to find it interesting, but not enough to spot the red flags. Your financial literacy matters more than ever. You don't need to become a blockchain expert. You need pattern recognition to spot when you're being sold a dream rather than investing in reality. You need to ask hard questions. Promotional materials hope you won't ask. And you need to be comfortable walking away from opportunities that don't pass scrutiny, even when you're worried about missing the next big thing. As we look toward the horizon of 2026, the question isn't just about one token or one company. It's about how we protect our legacy in a financial system being rewritten in real time. So what did I tell my neighbor when he asked about moving $20,000 into this opportunity? I showed him one calculation that would give us our answer on launch day, one metric that separates real protocol utility from a classic pump and dump scheme. This is the knowledge that could save you not just from this specific opportunity, but from dozens of similar pitches you'll encounter in 2026 and beyond. The metric is called the volume to market cap ratio, and it's the only number that truly matters when evaluating launch day performance. Here's the cold, hard calculation we have to make. If a project claims a massive valuation, but does not have the institutional liquidity to back it up, it's not an investment, it's a house of cards. Here's how it works. When any cryptocurrency or token launches, you can see two numbers immediately: the total market capitalization and the 24-hour trading volume. Market cap tells you the total theoretical value of all tokens at current prices. Trading volume tells you how much actual buying and selling happened in dollars over the past 24 hours. For legitimate cryptocurrencies with real users and genuine utility, this ratio typically ranges between 5 and 20%. Bitcoin, Ethereum, major stablecoins, they all show trading volumes that represent a reasonable fraction of their total market cap. This indicates real users buying and selling for actual purposes, moving money, executing smart contracts, providing liquidity. The trading reflects genuine economic activity. But in pump and dump schemes, you'll see something completely different on launch day. The trading volume will equal or even exceed the entire market cap of the project. You might see a project with a $50 million market cap showing $70 or $80 million in trading volume in the first 24 hours. This is mathematically impossible unless the same tokens are being traded back and forth multiple times. That's exactly what's happening. The scheme operators and early promoters are frantically trading with each other to create the appearance of massive demand. They're driving the price up artificially to trigger fear of missing out in observers watching the charts. Every rapid price increase you see is designed to make you think, I need to get in now before it's too late. The goal is attracting new buyers who will purchase at inflated prices, allowing the original promoters to sell their tokens for massive profits before the inevitable collapse. Let me give you a specific scenario based on patterns we've seen repeatedly in 2026. A project launches at 10 cents per token with 100 million tokens in circulation, creating a $10 million initial market cap. Within hours, the price climbs to 50 cents as coordinated buying drives it up. New investors see a 5 times gain in hours and rush to participate. The market cap is now $50 million. But when you check the trading volume, you see $80 million changed hands. That means the entire supply of tokens was bought and sold nearly twice over in less than a day. This is your red alert. This is not organic adoption. This is not genuine market enthusiasm. This is orchestrated manipulation designed to separate you from your money. The volume typically collapses within days or weeks after launch as the promoters exit their positions, and new buyers realize they are holding tokens with no actual utility or underlying demand. The price falls back below the presale level, often dropping 90% or more. Later, investors face significant losses, while the original promoters have extracted real dollars and moved on to the next project. My neighbor's opportunity showed every sign this pattern would repeat. The presale structure gave early participants tokens at $0.012. The marketing created massive artificial hype across online communities. The exchange listing claims were designed to trigger credibility by association. Everything was engineered to create explosive launch day volume from coordinated trading while attracting unsuspecting retail investors at peak prices. I told him to wait for launch day and watch the volume to market cap ratio. If it exceeded 50% in the first 24 hours, he should walk away immediately regardless of how much the price climbed. That single metric would tell us everything we needed to know. But there's another threat emerging in 2026 that makes this landscape even more dangerous, and it's something that specifically targets the demographic my neighbor belongs to. American seniors managing their own retirement portfolios. We need to talk about deepfake finance and how artificial intelligence is being weaponized against American investors. You've probably heard about deepfake technology, artificial intelligence that can create convincing fake videos or audio of real people saying things they never said. This technology has crossed into financial fraud in a major way over the past year. Scammers are now using AI to clone the voices and faces of trusted financial leaders, famous billionaires, even Fed officials, making it appear they're endorsing specific tokens or projects. According to the Federal Trade Commission, American seniors lost hundreds of millions of dollars throughout 2025 to these scams, and the problem is accelerating in 2026. Here's how it works in practice. You're scrolling through social media, and you see what looks like a video of a respected investor discussing a new project. The production quality might be slightly off, perhaps a grainy social media ad rather than professional studio footage, but the voice sounds right, the face looks right, and the message is clear. Buy now before it's too late. But none of it is real. The person never said those words. The interview never happened. The endorsement is entirely fabricated by artificial intelligence. This tactic is particularly effective at bypassing skepticism because we're conditioned to trust visual and audio evidence. If we see and hear someone we respect apparently endorsing something, our brains give it credibility, even if we'd normally be cautious. In 2026, our eyes and ears can be deceived more easily than our bank statements. The scammers know this, which is why they've invested heavily in perfecting these techniques. The warning signs to watch for. First, be suspicious of any investment content that appears outside official channels. If a major investor or a business leader has genuinely endorsed a project, that information will be available on their verified social media accounts, their company websites, or through legitimate news sources. If you're only seeing the content shared in investment forums or through promotional channels, verify it independently before giving it any weight. Second, pay attention to context and timing. Deepfake content often appears just before token launches or pre-sales, timed specifically to drive investment during critical periods. If you're seeing multiple endorsements from different authorities all appearing simultaneously, that's a red flag suggesting coordinated fabrication. Third, verify through multiple sources. If someone supposedly endorsed a project, search for that person's name plus the project name through news sources and official announcements. Real endorsements generate coverage. Fabricated ones exist only in promotional echo chambers. The other major threat targeting American investors in 2026 is wallet cloning techniques. Your cryptocurrency wallet is essentially your bank account in the digital asset world, controlled by private keys that prove ownership. If someone gains access to your private keys, they can drain your wallet completely, and unlike traditional banking, there's no fraud protection or ability to reverse transactions. Scammers have developed sophisticated phishing techniques specifically targeting cryptocurrency investors. They create fake websites that look identical to legitimate wallet providers or exchanges. You think you're logging into your real account, but you're actually entering your credentials into a clone site that captures your information. Within minutes, your funds are gone. The sophistication extends to hardware wallet attacks. Hardware wallets are physical devices designed to keep your private keys secure offline. But scammers have created counterfeit hardware wallets that look identical to legitimate products, complete with official packaging and branding. These devices are preloaded with malware that transmits your keys to the scammers the moment you set them up. According to blockchain security firm Chainalysis, these wallet cloning and phishing attacks cost American investors hundreds of millions of dollars throughout 2025, with the majority of losses concentrated among investors over age 55. This demographic is specifically targeted because they often manage larger portfolio values and may be less familiar with digital security best practices. Protection requires multiple layers of defense. Never access your cryptocurrency wallets through links sent via email or social media messages. Always type the URL directly into your browser or use bookmarks you've created yourself. Enable two-factor authentication on every account, preferably using hardware security keys rather than SMS codes, which can be intercepted. Never share your recovery phrases or private keys with anyone, regardless of how official their request seems. If someone contacts you claiming to be from customer support and asks for your security credentials, it's a scam. Legitimate platforms never ask for this information. If you encounter technical problems, navigate to the official website independently and contact support through verified channels. Now let's talk about the broader economic context that makes caution particularly valuable right now. We're standing at a massive crossroads. Our financial system is being rewritten in real time, and we're approaching a significant transition point in American monetary policy that creates uncertainty across all investment markets, not just cryptocurrency. Federal Reserve Chairman Jerome Powell's term ends in May 2026. Presidential appointments to the Fed chairmanship carry enormous implications for interest rates, inflation policy, and market stability. When the leadership of our central bank is up in the air, the noise in the investment world doesn't just get louder, it gets dangerous. Markets don't like uncertainty. Investors don't know what policy direction the Fed will take under new leadership. Will they maintain current approaches to inflation fighting? Will they shift toward more aggressive rate cuts to stimulate growth? Will they prioritize employment over price stability? These questions create hesitation in institutional capital and amplify market swings. This is precisely the environment where speculative investments become most dangerous. When traditional markets show uncertainty, the temptation to seek alternatives intensifies. But that's also when scammers become most active, knowing that psychological pressure makes people more susceptible to promises of extraordinary returns. Think about your investment strategy in this context. You've spent decades building your retirement savings, possibly 40 years or more of disciplined work and careful decisions. You've weathered multiple market cycles, recessions, and periods of volatility. You've made thoughtful choices about asset allocation, diversification, and risk management. Now, in an uncertain transition period with recession odds at 35% and inflation still eroding purchasing power, is this really the moment to let your hard-earned capital be evaporated by a 45-minute AI-generated hype cycle? The most powerful tool in the American investor's arsenal isn't finding the next big opportunity. It's disciplined patience. The most profitable investment you can make in the current environment isn't chasing speculative gains. It's capital preservation. Protecting what you've built matters more than gambling on promises that probably won't materialize. We are entering a phase where doing nothing might just be the most profitable move you make all year. Here's your exit and preservation strategy for navigating 2026. First, acknowledge that missing out on a legitimate opportunity costs you nothing except potential gains you never had. But falling for a scam costs you real capital you spent years accumulating. The asymmetry of these outcomes should guide your risk tolerance. Better to miss 10 legitimate opportunities than to lose significant capital to one elaborate fraud. Second, understand that as we navigate the innovation exemptions and shifting sands of the SEC's regulatory framework, legitimate technological revolutions don't require you to invest during pre-sales or early launches. Amazon went public in 1997. You could have bought shares years later and still made extraordinary returns as the company grew. Apple nearly went bankrupt in the 1990s and recovered to become one of the world's most valuable companies. Patient investors who waited for proven business models and actual market traction did just fine. You don't need to be first to benefit from genuine innovation. Third, apply a simple test to any investment opportunity that seems too good to be true. What percentage of your portfolio are you willing to lose completely? Not what percentage are you willing to invest, but what percentage can you afford to lose entirely without impacting your financial security or retirement plans? If the answer is less than the amount being requested, the decision is simple. Don't invest. Fourth, remember that scarcity and urgency are manufactured specifically to override your rational decision-making. If an opportunity is legitimate and will genuinely succeed, waiting a few months to see actual market performance won't cost you meaningful returns. If waiting means you miss the opportunity entirely, that tells you the opportunity was designed to extract money from early participants, not to build sustainable value. Fifth, recognize that the complexity of an investment pitch is often inversely related to its legitimacy. Real businesses can explain what they do and why it matters in straightforward terms. If you need to read a 100-page white paper filled with technical jargon to understand the value proposition, you're probably looking at a sophisticated attempt to hide the absence of real value behind impressive-sounding complexity. When my neighbor asked me for advice on his $20,000 decision, I didn't just explain the red flags. I asked him to think about what that money represented in his life. It was roughly 6 months of emergency fund reserves, money he might need if unexpected medical expenses arose, capital that could support him and his wife if their retirement income fell short in a recession, funds that took years of disciplined saving to accumulate. I asked him to imagine 2 scenarios. In the first, he invests the $20,000 and the project succeeds beyond expectations. His investment grows to $50,000 or even $100,000. His retirement becomes more comfortable. He has extra security and perhaps can help his grandchildren with college expenses. That's a wonderful outcome that would improve his life in meaningful ways. In the second scenario, he invests the $20,000 and the project collapses as a pump and dump scheme. He loses everything. His emergency fund is depleted. When his car needs unexpected repairs or his wife requires medical care beyond insurance coverage, they have to make difficult decisions about where to cut expenses. They might need to ask their children for financial help, reversing the support dynamic he'd hoped to maintain. The stress impacts his health and his marriage. Now compare the magnitude of these outcomes. The gains in the first scenario would be nice, but not life-changing. They'd add comfort and security, but wouldn't fundamentally alter his retirement reality. The losses in the second scenario would be genuinely harmful, creating stress and vulnerability that could impact multiple areas of his life for years. This asymmetry is what investors call risk-reward analysis, and in this case, the risk far outweighed the potential reward. The probability of the first scenario was low, given all the red flags we'd identified. The probability of the second scenario was high. The decision became clear when framed properly. He decided not to invest. 2 weeks later, the project launched exactly as I'd predicted. The volume to market cap ratio exceeded 200% in the first day. The price spiked dramatically in the first 6 hours, then began falling. Within 3 days, it had dropped 70% below the presale price. Within 2 weeks, the promotional accounts that had been flooding forums with positive comments went silent. The project's social media presence vanished. The promised exchange listings never materialized. My neighbor had protected his capital by asking the right questions and understanding the warning signs. The $20,000 remained in his money market account, earning modest but safe returns while providing the security he actually needed. This is the knowledge I want you to take from our time together. The 2026 financial landscape is filled with sophisticated schemes designed to exploit uncertainty, economic pressure, and our desire for opportunity. The tools have become more advanced, the marketing more professional, the psychological manipulation more refined. But the fundamental patterns remain recognizable once you know what to look for. You don't need special expertise or inside information to protect yourself. You need skepticism, patience, and willingness to walk away from opportunities that don't pass basic scrutiny. You need to ask about utility, verify claims independently, watch for red flags, and prioritize capital preservation over speculative gains. The $850 billion return crisis is real. Digital twin technology might eventually play a role in solving it. Blockchain could potentially add value to commerce and supply chain management. Some legitimate innovation is happening in this space, and patient investors who wait for proven business models and actual market adoption might benefit from it eventually. But the presale opportunities flooding your inbox and social media feeds right now aren't how you'll participate in that innovation. They're how promoters will extract your capital while promising you revolutionary returns that will never materialize. The revolution might come, but it won't come from projects using every red flag in the scammer playbook while targeting retirees with aggressive promotional campaigns. Your best investment in this uncertain environment is the knowledge to distinguish between opportunity and trap, innovation and illusion, legitimate business and elaborate fraud. That knowledge doesn't expire when one project collapses. It protects you from the next pitch and the one after that. It serves you across market cycles and regulatory changes and technological trends. By staying informed, questioning the Big Four listing claims, demanding to see working products before investing, and waiting for real-world utility to prove itself, we aren't just protecting our own portfolios. We're demanding a higher standard for the entire American economy. We're insisting that innovations serve actual needs rather than just extracting capital from hopeful investors. In a year where recession odds are climbing, purchasing power is declining, and major transitions in monetary policy create uncertainty, caution isn't just protective, it's profitable. The capital you preserve today remains available for genuine opportunities tomorrow. The scams you avoid cost you nothing except the imaginary returns you were never going to realize anyway. That's the calculation. That's the final verdict. Awareness is our ultimate defense. Protect what you've built, question what you're shown, and remember that missing out on speculation isn't the same as missing out on opportunity. The real opportunity is securing your financial future by making decisions based on evidence rather than excitement, mathematics rather than marketing, and preservation rather than promises. Together, we're making sure that our future remains exactly that, ours.